Everyone, today is the 30th of October 2025. Carvana fraud, the smoking gun, is today just Dario Daily. Before we begin, if you like my channel and want to support it, don't forget to like the video, subscribe to my channel, and to turn on the notification not to miss my future updates. All right, let's kick off. Yesterday, Carvana filed its 10Q for the last quarter, and as usual, I took some time to look into it. 2 weeks ago in Carvana, a ticking time bomb, I already highlighted numerous red flags about this company. However, none of them was an undeniable smoking gun that could prove beyond a shadow of a doubt the ongoing fraud. Today, I am going to present you the ultimate proof that this company is cheating on its accounting in order to inflate its revenues and extract cash from banks and private credit lenders. This last quarter, Carvana reported it sold 155,941 car units to retail, sold 8,369 cars wholesale, and handled 260,805 car units in transactions in its wholesale marketplace in Q3. Remarkable, isn't it? Especially when these numbers continue to grow while the used car market is reportedly heading in the opposite direction as a whole. Considering the competition and the growing supply in Carvana's market, it is fair to expect an impact on business margins at the very least. Nope. Carvana, like a salmon swimming against the current of a river, still reported a chunky 20% gross profit from buying and selling used cars, for a total of $3.14 billion in the first 9 months of 2025. As a comparison, CarMax, Carvana's direct competitor and with a business of similar size, has a profit margin of roughly 10%. At this point, you might ask yourself what Carvana's secret is for being so profitable. The answer lies in its gains from loan sales disclosures. The total gain related to finance receivables sold to financing partners and pursuant to securitization transactions was $331 million and $224 million during the 3 months ended September 30, 2025 and 2024, respectively, and $878 million and $541 million during the 9 months ended September 30, 2025 and 2024, respectively, which is included in other sales and revenues in the accompanying unaudited condensed consolidated statements of operations. Here, Carvana is telling us that 70% of its $1.27 billion of other sales and revenues are gains from selling loans. Considering that Carvana sold $3.1 billion of car loans in the first 9 months of this year, a 28% profit from selling its loans is unrealistic, but not impossible in pure terms of probability. Don't take me wrong here. There is a small problem here, though. Do we all agree that if Carvana is selling loans, it should report a cash gain in its statement of cash flows? I assume we do. However, as you can see in the highlighted row, Carvana reports a negative cash item, which implies a cash outflow related to selling loans in its cash flow statement. Ladies and gentlemen, here is the smoking gun. Without this blatant accounting shenanigan, Carvana would have never been able to report a profit since it miraculously escaped bankruptcy a few years ago. Since the narrative that propelled the stock to jump from $4 to $400 per share would not have been coherent with its business performance. As if this wasn't enough, digging through Carvana's 10Q, things become even murkier. As we saw earlier, the company considers as gains on loan sales the total gain related to finance receivables sold to financing partners and pursuant to securitization transactions. This statement is aligned with cash flow statement items, originations of finance receivables, and proceeds from sales of finance receivables net, that together account for a $403 million cash inflow in the first 9 months of 2025, an amount that, very strangely, is similar to the one recorded for the same period of 2024, despite almost 30% lower volumes. Hold on a second. Aren't gains related to finance receivables sold and gains on loan sales exactly the same thing? Arguably, they are. Does this mean that there is a chance that Carvana sold some of its finance receivables twice, like First Brands Group did? I will leave this question open. At this point, it is fair to ask ourselves which financial institution is on the hook in case of a Carvana sudden collapse. From Carvana's disclosures, we know for sure that Ally Financial is on the hook for $3.2 billion. However, considering the total volume of finance receivables sold is over $9 billion, it is fair to assume that more financial institutions are exposed to Carvana. And we know that frequent partners of its securitization business are the likes of Wells Fargo, Bank of America, Citigroup, and Jefferies. To conclude, I believe there is no more doubt about Carvana being a ticking time bomb that can explode anytime and create incredible damage to many banks and private credit lenders. Considering how dependent this company is on raising cash by selling finance receivables, and that the market for ABS auto loans is currently frozen due to investors stepping away, and finally, doing some proper due diligence, I personally expect it won't take long before we see fireworks here. Thanks a lot for listening to my podcast again today, for all the great support and following that you give me on X, on Instagram, and for reading my research on justdario.com. We are definitely going through incredible time, and I hope this article, like many one that I put out there, will be helpful to you to make better informed decision. I wish everyone a nice day.